Hi, I'm Roger Montgomery from rogermontgomery.com and welcome to another episode of Value.able TV. In this episode I want to talk to you about another rule for selling, and I appreciate that not everybody follows our approach. These rules are only designed to fit with the idea that if you accept it, you're buying high quality businesses at discounts to intrinsic value. And bottom line, that's all we're talking about here. Buying great quality companies when they're cheap. You know what? Sometimes we're going to be wrong about when they're cheap. Sometimes we're going to be wrong about whether they're great quality companies. But most importantly, over time and with the benefit of some diversification, if you follow an approach of buying great businesses, extraordinary companies, when they're at big discounts to estimates of intrinsic value, conservative estimates of intrinsic value, then you should do okay. But the big question that's left unanswered with that statement is when to sell. Now, in this episode, what I would like to do is talk about when to sell because a company's shares are expensive. Some people believe that a share is expensive when it's got a high PE ratio. I don't subscribe to that view. I believe a share is expensive when it's not only more expensive than my estimate of its intrinsic value this year, but also my estimate of its intrinsic value next year and the year after. So if, for example, I've bought a company's shares at $2 and the intrinsic value, or my estimate of intrinsic value this year, is $4, then if the shares go to $4.10, unless there's something else that's happened, I'm not going to be selling. If, however, my intrinsic value for next year is $4.20 and the year after is $4.40, and the shares rally to $4.50 or $4.60, then that, in the absence of any other information, would probably prompt me to sell the shares. Now, that's just the way I manage my portfolio and the way I manage the portfolio of the fund. But you don't have to follow that particular rule. I just think it's a sensible rule for the way I manage money. You, on the other hand, may have a view that it needs to be 20% above or 30% above, or it needs to double before you're going to sell. And it might be that there's another rule that you've got, which we'll talk about in a future episode of Value.able TV, that comes in earlier and causes you to sell the shares. Whatever your rules are, it's important that you stick to them. It's important that you have a set of rules for every contingency and you follow those rules. I'll see you next time on another episode of Value.able TV.